Good morning, everyone. My name is Peter Gilfillan, and on behalf of IMN, I'd like to welcome you to the Single Family Rental Virtual Forum. We're delighted to bring together so many industry participants over the next 2 days during a challenging period of time where unfortunately we cannot convene in person. It's really a testament to the resiliency and adaptability of the industry that we're able to host this event and bring you a full slate of timely and topical discussions and opportunities to network with your peers. If you haven't already, please do explore the Hub platform, watch our user experience video guide, which can be found in the resources tab, add sessions to your personal schedule, and set up meetings with other attendees. We'll be kicking things off today with some opening thoughts from Jeff Cline, Executive Director, SVN SFR Hub Advisors, immediately followed by a discussion on the state of the single-family rental industry today. And Jeff will be joined by a wonderful group of experts ready to address this topic. I'd like to go over a couple of housekeeping items before I hand things over to Jeff. So please do feel free to submit questions throughout the session. You can do this using the Q&A button at the bottom of your Zoom window. You can view other people's questions, upvote them, and then the most popular questions will be prioritized and addressed first. You'll also notice that the Hub platform is still open in your original browser tab from where you launched the Zoom window. So you can communicate with other attendees using the chat function in Hub, and you can message someone privately by clicking on their name. Also on that Hub page, you will see an evaluation section, which allows you to evaluate that session and leave comments for suggestions for future discussions. We'd like as many of you as possible to do that evaluation, but you will need to have that particular session added to your personal Hub schedule in order to do so. So please go and add all the sessions that you want to partake in today to your personal Hub schedule. And I think without any further ado, I'd like to hand things over to Jeff Cline to get us started. Thank you, Jeff.
Thank you very much, Peter. Good morning and welcome to the 2020 IMN Single Family Rental Virtual Conference. I'm Jeff Cline, Executive Director for SVN SFR Advisors, and we're proud to join with other event sponsors and IMN to provide a safe 2-day virtual conference for SFR empowerment, education, and networking, all in the comfort of your home office, kitchen, living room, basement, maybe even a treehouse if you're at that point already. We hope the nation's first all-virtual SFR conference finds you and your family safe, healthy, and creating a new normal as we meet this week. As you can expect, IMN has done a wonderful job producing a safe and efficient virtual conference, recreating what was previously a physical conference gathering that we have all enjoyed in the past years. Our conference is packed with SFR industry leaders from every support segment. Over the next 2 days, you now will have the opportunity to access these leaders during panel discussions or even schedule a private or group meeting. I believe you'll be really impressed with the simplicity yet super effective technology that has been built to ensure that you optimize your time spent over the course of the next couple of days. The last IMN conference, as we know, was here in Phoenix in December. Wow, is it just me? It seems like that was like 10 years ago, and it was merely 9 months. Okay, it's now 2020, and we all operate at home and office under COVID-19 guidelines. Let's take a quick look at 2020 as the SFR industry has fared pretty well so far, but it's early in the COVID-19 cycle, as we all know. Let's take a look at quarter one. Quarter one this year in 2020 was business almost as usual. Performance and growth spilling over from 2019. In January, the Urban Institute reported rental demand continued to grow. It was reported 3.4 million millennials preferred to rent rather than buy a home, an all-time high. February 2020, Urban Institute's Housing Finance Policy Center reported single-family homes for rent are the fastest growing segment of the U.S. housing market. And finally, in quarter one, more than a third, or 39% of all U.S. rental properties are now single-family homes, the highest percentage since 1965, while home ownership is an all-time low. Let's move on to quarter two. Wow, we saw some changes. By mid to the end of March, business was not even close to being business as usual. It's time to shift and perform. At that point, obviously, federal and state stimulus discussions started in DC and were rolled out very quickly thereafter. We saw April 1st, SFR April rent collections were only slightly lower year over year. However, not bad compared with the multifamily industry. We saw virtual and touchless leasing launched literally overnight in a big way by property management and leasing firms. Acquisition asset inspections became a whole new challenge at that point for us all. The US Census Bureau published an all-time high rental occupancy rate in Q2, taking into consideration the suburbs at an average of 5.3% and a rate in principal cities at 5.6%. So occupancy and rents were continuing to stable in Q2. Let's take a look at what's coming up in Q3 2020. We expect continued managed growth, a new normal, and possibly new tenant groups moving into the SFR rental homes that have been soft groups or profiles prior to now. As a result of not being required to be in the employer's office every day of the week, it's been reported by several sources that remote working should cause a shift of high-income workers to the suburbs and low-cost markets, potentially upending the long-running megatrend toward urbanization. So that could very well create new tenants for single-family homes. It's also estimated that additional new secondary tenant groups may migrate from apartments, potential homeowner foreclosures, and it's reported 43% of renters have delayed home ownership plans due to COVID-19, creating new rentals during the course of 2020. Look for new construction fee simple built for rent homes to expand big time during 2020. There's going to be several sessions during our conference over the next couple of days that specifically really gets in the weeds and talk about some of the details and, more importantly, the opportunities in the built for rent segment. Oh, this is great. The new Green Street work from home factor. I love this. It's the WFH factor. It's a new unit of comparison that we all can use for acquisition of single family rental home investment. The factor ranks single family or SFR the top investment class when compared to other CRE segments. So when you look at the effects of working from home, which investment segment is anticipated to perform the best? It's SFR, and that's over multifamily, urban, in town, obviously office, retail, and other commercial real estate segments. So that's pretty exciting, a whole new business or unit of comparison essentially. Let's go to the next slide, Peter. John Burns Real Estate Consulting gives the industry and has over the course of the last few months pretty high marks, although being conservative, yet to be determined exactly what's going to happen. We see and we've learned in John Burns' weekly reports that there's been continued strong demand during COVID-19 for SFR rental housing. That's anticipated to continue through 2020 and beyond. 2020, the strongest rent growth, and Ben's going to go through this in detail on the next slide. The strongest rent growth has been in Charlotte, Phoenix, and Tampa, all in the 3% range since the first of the year, beginning of 2020. 2020 to 2023 rent growth is anticipated in a couple of top markets, Charlotte and Phoenix specifically, in the 4.5% range. So that's it for the stats at this point. Let's get this conference started. We've got an expert panel that IMN has been very successful to put together for today's opening panel session. Gentlemen, thank you so much over the course of the last couple of weeks. I know you've worked hard in preparation for today's panel, putting together some great information for the attendees that I believe will be some good takeaways. And this information, I might remind the attendees, will certainly be available in PDF form post-panel discussion today, as well continued in other panels as well. Just a request, and you'll receive the slides and the data. So gentlemen, let's start with a brief introduction of yourself. Ben, would you like to start?
Yeah, thanks, Jeff, and good morning, IMN. This is Ben Hall. I serve as Vice President of Product for Altisource.
Thank you, Ben. Tim?
Good morning, industry, and good morning, Jeff. I am Tim Reilly, I'm Executive Vice President for Asset Management Services with Radian.
Mathew?
I'm Mathew Avrhami with Harvard Investments as Vice President.
Thank you, gentlemen. As you can see, we've got a great cross-section of many different segments of the SFR industry. These are experts within our industry. You have the opportunity to actually ask these panelists questions. So please click on the Q&A symbol on the Zoom in the lower toolbox, and we'll address your questions as they come in.
Jeff, we'd like to introduce Sean as well.
Oh, I'm sorry, Sean.
Hey, good morning, everyone. Good morning. Thanks, guys. I'm probably hiding in the top left corner up there. So no worries at all. But Sean Breuner, founder, CEO of Von Stay. We are a tech-enabled consumer brand in the hospitality space, and specifically focused on single-family rentals. So excited to be here and talk to everyone.
Thank you, and I apologize, Sean. I didn't see you on the video, so sorry about that.
No
okay, gentlemen. Let's get into the questions. We've put together collectively between our expert group and IMN some great questions with some very knowledgeable answers that will give you some stats and some pretty good takeaways to get this conference started today. Let's get started. Everybody wants to know question number one: where are the hottest markets in terms of SFR performance versus other real estate sectors in different markets across the country? And Ben, I believe you have the next slide to share some data.
That's right. Thanks, Jeff. And while it's exciting to see which markets are heating up with activity and rent growth, a different look may be required before deploying capital into an MSA. So as Jeff highlighted on the earlier slide, Phoenix should boast some significant gains if already in that market, right? However, if you're looking to get in or expand, Phoenix may look a little bit overpriced with lower yields and some economic pressures. So we're going to take a wider look here. So employ a wider data set to provide a more balanced view when considering which markets to invest in. Okay. This slide is going to present a weighted view of 7 metrics and the resulting 10 top performing markets. So some of these metrics are going to be focused on rental performance, such as gross yields and rent growth. Others more on economic factors, such as unemployment rate, rent versus income, and job recovery since February 20. So looking at the results, you'll see the smaller segments represent a higher rank for that market. Ogden ranked highest with average rental with an average to slightly above average rental performance and strong economic stability. Atlanta came in a close second with a much more balanced rank of rental performance and strong economic stability as well. Every investor has its own unique strategy and will undoubtedly put a different weightage to various metrics when making investment decisions. Other factors such as landlord-friendly states may be of significant importance to investors working in low income or higher unemployment areas. So to be clear, this slide's not suggesting every SFR investor begins sourcing assets in Ogden, Clearfield, Utah immediately after the session. The general message here is to highlight the value of bringing in multiple data points that closely align to your investment strategy, creating a balanced and longer-term market view. And with that, Jeff, I'll turn it back over to you.
Okay, thank you, Ben, and we appreciate you sharing these stats today. Sean, what are you seeing in the markets that you operate in?
Yeah, so very interesting. We operate in about 15 markets. So we're in both urban and then what we call tier 1 destination, or kind of these tertiary markets that sit outside of the large MSAs. And with the digital economy right now, we're seeing a real bifurcation of demand. So you're starting to see in places like Sonoma and Palm Springs and Lake Tahoe on the West Coast, and even in places like Breckenridge and some of the places in the Midwest that sit outside of these large core MSAs, increases in rental prices. Obviously, everybody is kind of taking this mad rush outside of urban epicenters with the coronavirus and COVID-19. And so that's created a lot of demand and rental growth in those markets. We're also starting to see the warmer climates outperforming. And so even places like San Diego and Scottsdale, for example, Scottsdale is not usually a place that you go to in August, but we're seeing a lot of demand in those markets, especially Palm Springs. I mean, Palm Springs, I was out there, a couple of weeks ago. It was 120 degrees. And homes are filling up left and right. So it is quite interesting because we are in urban and destination. And destination, as you guys all know, due to the digital economy, is really driving the capability to work from home and work from these remote areas where, maybe in the past you were in core urban epicenters. So that's been quite a movement over the past few months, Jeff.
Sure. Well, I believe probably just Matthew and myself are the only two individuals left in Scottsdale in August. Looks like Matthew's air conditioning is working well this morning. Matthew, I know Harvard Investments is growing into multiple markets other than Phoenix, Arizona. What do you see and what's your targets?
Yeah, Harvard Investments, we're developing horizontal apartments and single-family rental homes and purpose-built communities. So we're active in Phoenix, Austin, and Vegas, and we like those markets. I think Vegas is going to have a little bit of headwind with the unemployment they're facing due to casinos being shut down. But outside of that, I would say the hottest markets are certainly Phoenix. It's shown tremendous resilience throughout this time. Austin's doing really well. They just, they've got Tesla that's made a big announcement and some other major employers that'll continue to grow jobs, although infrastructure, transportation seems like a limitation for them. And outside of that, I would say Atlanta, Dallas, and Raleigh. I think there's a real shift from urban markets to good, larger suburban markets. So,
Sure.
Some people might say tier 2, tier 3 cities. I've just seen at least 2 reports in the past 24 hours about how urban rents are soft. New York, San Francisco area, high density urban areas are just soft, and I think the work from home shift is a factor in that.
Sure, you bet. And it's interesting you mentioned tier 2 and tier 3 markets, Matthew. It's just been a couple of years, 2 or 3 years ago, I remember at the Miami IMN conference, was kind of the first conversations on some of the panels regarding tier 2 and tier 3. So we've all had a few years here to start to check some of those markets out. Tim, what's your thoughts on the hottest markets across the nation?
Thanks, Jeff. And I completely agree with Matt's assessment. We have moved into the tier 2, tier 3. But the point I want to get across to everybody is the strong markets going into COVID have remained strong. So Phoenix was strong before, Phoenix is still strong. But then all these tier 2s started popping up, or tier 3s like Indianapolis. That's a market that you can see the capital markets players very much going into. Columbia, Nashville is still hot, as well as Atlanta.
Sure, I agree. And one thing that we've seen in regards to SFRhub in the build-for-rent sector being kind of a subsector in the SFR investment space, the build-for-rent seems to be on fire and really growing in just about every major, the top 25 or 30 markets, not only tier 1, but tier 2 and tier 3. So substantial growth there, many top markets in that subcategory. Okay, gentlemen, let's move on to question number 2. Tim, you'll be up for first answer on this. How are owners reacting to the current market? Discussion on future of large versus regional versus small owner operators in the SFR space. So how are the owner operators really reacting across the country? What do you see?
Yeah, so let me start with the large owner operators, the Tricons, Invitation Homes, Progress, First Key, companies like this. If I was giving a grade and could give a grade, it would be an A+ across the board. The amount of transparency and dedication for the large institutional operators has been amazing. The examples that I have is out of the gate, those operators have been extremely customer-centric to ensure that the renters who are their customers have had solutions through this crisis. I think from the outside looking in, the dollars that they have spent since 2013 building up their infrastructure, their backroom operation, has really come through in flying colors, where they have very sophisticated call centers now, a distributive network, vendor partner network with repair specialists, maintenance specialists, and then they came up with very creative solutions to help their customers through this crisis. So A+ as we're 5 months into this into this crisis.
Sure. Ben, what's your thoughts on how the owner-operators are reacting in the current market?
Yeah, thanks, Jeff. I think similar to what Tim shared, the mid to large investors reacted quickly, really immediately after the pandemic. So I think in April, we spent a considerable amount of time opening up the two-way communication between tenant and, management companies. Collections have remained relatively strong. So I think, there's maybe some concern going into the end of the year, but still optimistic about the market, with different state moratoriums and the like. But, they've really been able to keep collections strong and really allowing them to focus on maybe other strategies right now with either optimizing operations, looking for emerging opportunities, or possibly taking a step back from acquisition mode and, realigning its portfolio strategy, right? Some might be exiting and entering different markets to balance their portfolio. The flip side is a smaller investment, which makes up the larger portion of the SFR industry today. They're really heavily impacted by turns in a weakened economy. So there's a good amount of fear, I'd say, and concern with the smaller mom and pop investors. They're often more inclined to secure financing or sooner if they're able to, and they may already be looking for an exit strategy. So there might be some opportunity there as well for mid to large to pick up some market share. But eviction moratoriums have certainly put a tighter squeeze on the smaller investors, operating with less sophisticated property management strategies and really struggling to collect rent. So I think it's really shown a good light on the mid to large investors on just how stable the economy is if you're operating correctly in the market.
Agreed on all fronts. Sean, we'll start you off with this question. Rent and renter growth factors. What are you seeing? Are we on a break? We just saw on the John Burns real estate consulting slide that the industry or the data really supports a bit of rent growth, in particular MSAs. What's your thoughts and what do you see?
Yeah, it's interesting because we follow John as well, and supply inventory is down 28% year over year across the country for single family rentals, and I think it's very much region based. So we're seeing rents, and this is more of less of the data and more of just kind of how you feel when you go out there and you're renting properties and acquiring properties. But in areas like San Diego or even Nashville, we're seeing some softening relative to these tertiary markets. The tertiary markets are seeing a mad rush where people are looking for single family rentals, and there's really very little verticalization in those regions. And so that horizontal SFR product where you can control the experience, control who you're living with families and all that kind of stuff, and not have to go in elevators. I mean, that's a big movement. And the question I think for everybody is that going to remain? Is that here to stay? And oftentimes, when some of these habits or some of these trends start to move in a certain direction, they start to stick. And obviously we're very, very early days here, but we're not seeing any slowdown of this movement. And when you see Google, for example, that says, hey, everybody can work from home through June of 2021, that's a big decision. And you see a mass exodus outside of San Francisco. And where do those people go? They go to Sonoma, they go to Lake Tahoe, they go to the suburbs. And work from home, when a company that's worth $1 trillion says everybody can work from home for a year, that starts to become a habit, and that starts to become very comfortable. And then the home office opens up. And these are all things that don't happen in multifamily. They happen in single family rentals, where you have enough space and room and you don't feel like people are on top of you. You can go into the backyard and get a little space and take a phone call. So I think, we're really seeing rental growth pick up in all of those in all the tertiary markets outside of those MSAs, and urban's getting hit.
Sure, agreed. Mathew, what do you see? Your company specializes in the horizontal apartment regime. What do you see in that subsector from a rent and rent growth standpoint?
The sector's doing great. There's tremendous demand for the product. First off, there's a housing shortage across the nation, and in markets with strong job growth or strong employment base, I mean, it's even more pronounced. So we're kind of benefiting from that tailwind, and then we're offering a product that has 1, 2, 3 bedroom homes detached with the yard, It's got a doggy door. It's a smart home, so they can turn the lights on or control the electricity when they're not there. And, you know, we've got some light amenities, and it's just, it's kind of, I take a step back and kind of scratch my head, because if you look at this from 50,000 feet, on one side, you've got single family homes that have been a rental option for folks for decades. On the other hand, you've got multifamily, and we've just kind of taken the two, and this is our new lifestyle that we're offering, and it's been received tremendously well.
Yeah, it's an exciting concept, that's for sure. Let's move on. This is probably one of the number one questions that our attendees would love to hear your comments and expertise. How have year-over-year rent collections performed between April and July? We were all, as an industry, a little on edge April 1st, obviously, after the shutdown commenced in mid to end of March. Ben, let's start with you. What have you seen from a data and research standpoint regarding year-over-year rent collections during COVID-19?
Yeah, thanks, Jeff. I think, you know, we're seeing two opposite ends of this spectrum, really. You know, at the small mom and pop investors, they're hitting really hard right now with collections. You know, some are reporting, you know, 25% unable to collect on rents. You know, conversely, you know, when we talk about the, you know, mid and institutional size investors, we're hearing really, really strong rent collections through July, really. So, you know, one institutional investor recently reported, you know, a July collection exceeding 99% of its trailing 12-month average, and that's, you know, managing over 10,000 homes. Most of the investors we speak with are confident going into the third quarter with collections. Some do share concerns going into the fourth quarter with uncertainty around unemployment and state-ordered eviction moratoriums. Some of that's going to be more geography-based as far as those concerns, you know, where they're heavy in their markets. But, you know, again, to the earlier point, you know, made by Tim and what I touched on, we're just not seeing as much concern with the larger operators that have more sophisticated operating platforms.
And Tim, let's move to you regarding year-over-year rent collections. As you see rent rolls come in your underwriting process, what do you see today? What's happened April 1st forward?
Yeah, I mean, speaking specifically for everything Ben said, I agree with. You have a downward pressure on the smaller players in the market, but when you think about the large institutional investor owner operators, they're looking at year over year collecting what they did the previous year. You're at north of 95% rent collected for every one of them, as reported through their earnings.
Sure. Terrific.
Hey, Jeff, can I jump in on that one?
Sure, Mathew.
I had kind of prepared something a little interesting and had a discovery I wanted to share. I'll put the slides up in the chat if folks want to see what I'm referencing. But I looked at the REITs, see what they were reporting on occupancy and rent growth. They're actually up on occupancy. Their operating margins are up. They're showing rent growth right in the 2.5% to 4% range year over year. This is all during the pandemic. This is a trailing 3-month look. On the other hand, if you look at multifamily, I think this is super interesting, and this chart is available too. But if you look at multifamily, their rent growth is soft or flat. It's really flattish. Mm-hmm. And so I think that's really interesting. And then I think the other part to kind of keep in mind is that the Fed has pumped $1 trillion into the economy, along with stimulus money that ran out at the end of July. And there's a tremendous level of uncertainty on how households are going to act when their next rent payment is due if another stimulus round isn't hit. I really haven't heard much, if any, about any kind of distress or lack of rent payments across the board on different properties. I've heard a little bit here and there, but for the most part, I think people don't want to move during a pandemic, and so they're doing everything they can to pay the rent. But as that starts to move past, as we start to move past that concern as, you know, a collective population, and there's a lack of stimulus money or job income to pay the rent, you know, that's when we'll see what collections really look like.
Sure. Thank you for assembling that data. We appreciate it. And click on Matthew's slides in the chat room. I'm sorry, go ahead.
Yeah, but from the large owner operator perspective, the stimulus didn't start for them early on, and they still had rent collections that exceeded year over year and occupancy rates that exceeded over year. And the more that I've reflected on this over the last 5 months and the research that we've kind of collectively done, we're at a point that it's no longer time to talk about SFR as an alternative solution to home ownership. SFR now is a solution. It is a lifestyle. And that really has taken hold over the last 5 months, as seen in the performance of these assets.
Sure, agreed. We've got an interesting question here that just came in on the question Q&A channel, which is interesting. It indicates nearly 1 in 6 FHA mortgages are delinquent. And it's asking about the comments from the panel. What's your thoughts as far as what's forthcoming in foreclosures in single family? Anyone want to take that?
Yeah, I can start and try to dovetail it into single family rental. There will be an increase in defaults. There has been an increase in defaults. There's an increase in forbearances, and invariably there's going to be an increase in foreclosures at some point coming up. Once the moratoriums lapse, et cetera, et cetera. However, if you think about that in terms of the single family rental business, in 2008 up through 2013, the institutional owner operators built their platforms on distressed properties. We have in place today a backstop to help augment the foreclosure crisis that may be coming with very sophisticated buyers of properties that are not afraid to buy, rehab, and re-rent. Many believe, including myself, that it was because of the foresight of the large institutional players back in 2012 and 2013. They actually were there to help stabilize neighborhoods, properties, MSAs. And so there will be foreclosures, but today there is definitely a backstop in the single family rental industry that can help mitigate what may be coming.
And Jeff, if I can add one thing, I agree with everything Tim said, but there's also a psychological that is impact, because right now most people have equity in their homes. If they've owned homes the last 5 to 10 years, they have equity. And I also read a report recently that said the savings accounts for the average U.S. consumer was the highest in history. So there's cash, there's pumping liquidity. The Fed's basically saying, we're gonna make sure that we prop this up under no certain circumstances. And then you have an incentive to keep your home. The incentive is that you have equity in it. In 2010, everybody went upside down. There was zero incentive to keep your home. And so I do think that plays a factor in terms of, how this, how people will stay in these homes and keep them, because there's value there. And maybe that's where inventory comes from.
Sure, understood. Thank you, Danny, for that question. And Eric, we're going to dovetail right into your answers to your question, and that this will be our last panel discussion question, and then we'll go to the audience to answer specific questions from the attendees. So how has, and this is an open-ended question, and it has long answers, so let's try and make it as short as possible, panelists. How has COVID-19 affected the SFR industry? We've seen over the last 4 months unemployment, stimulus, rent debt forbearance, FHA, and home ownership differentiating that we just touched on. What do you all see? There's a lot of big impacts that have already occurred and many that are forthcoming. What do you see the major challenge to be in the SFR industry from this point forward as a result of COVID-19? And Mathew, well, let's start with you.
Sure, I'll start that one off. I think that COVID has just really put a lot more premium on people's living space and workspace, and so as people, maybe didn't put as much of a premium on that in December or January 6 months ago, today, they're really spending a lot of time in those spaces, and so they want to think about, what's the quality of my space? Does it fit my needs? Can I do work from home? Is this a place where I want to be on lockdown? I mean, even if they don't think we're going to have another lockdown, I think it's kind of in the back of their head where, wow, I had to live in this box. Is this place I want to be? And so I just think all of that pushes people into wanting a backyard or wanting a additional bedroom or not sharing walls with a neighbor.
Yeah, and you made a good point a few moments ago, Mathew, in that the stimulus ended in July. So August, obviously, we've been in new territory again. It seems like every month the industry has some new major potential impact. We've performed well to date, but appears to be still a long road ahead regarding COVID-19. What's your thoughts, Ben, in regards to COVID-19 and all the major impacts that we've seen, both personal as well as governmental?
Yeah, I think just broad brushstroke here, it's been a net positive on SFR, right? So I think when you look at, we've talked about past few conferences that it's an emerging asset class. It's no longer emerging, right? It's a legitimate asset class. And I think, Wall Street certainly recognized that. Some of the points Matt just touched on, right? As far as, people really looking to go after the SFR for, that's where they want to move their family in a time of crisis or uncertainty. And SFR has already been operating incredibly well. It also is going to help, I think, right size the operating field. I think it's probably going to weed out some of the underperformers, some of those, with less integrity and how they're managing with their tenants. So I think that's going to be a net positive on the market as well. I just think we really saw some great action from the large institutionals. When the CARES Act came out, their first approach was to open up that two-way communication channel and educate their tenants on what it means. It doesn't mean that you get to pass up rent and you're going to be forgiven on the rent. So there was a lot of effort that went into that, but I certainly think it's shown a bright light on how these operators are performing.
Sure. Tim, could you give us a short summary on your thoughts regarding government and government programs and personal situations?
Yeah, I do agree with Ben that there was nothing like a crisis to show that the large owner operators were game ready. And if you kind of look and listen to some of the earnings calls from the owner operators, it really hasn't been the government stimulus that has kept that industry to be a darling of this asset class. Because early on, there was no eviction moratorium. There was no money coming in from the government. And so they haven't been able to quantify that that's how payments are being made. I really do think that from what we've seen over the last 5 months, that the de-urbanization has occurred, that millennials are making the choice to be in these homes that are well maintained by very sophisticated operators in the space.
Sure. Well, we're at the 5-minute alert mark today. We invite the attendees to click on the Q&A button and submit your questions, and we'll get to those in just 1 minute. Let's wrap up. Peter, if you can put on the next slide, flip activity and performance. Ben's going to give us some quick insight as to what's going on in the fix and flip market, as many of our attendees today practice in that space.
Yeah, thanks, Jeff. And this data was supplied by Rent Range, one of the AltaSource business units, and we're going to look at flip activity and performance. So looking at the map here on the right of most active markets, and then on the left, where we're seeing our strongest profit margins, top 10 and lowest 10. Three main themes here with this slide. Strong market activity doesn't translate to strong profits. MSAs with older neighborhoods present greater opportunity for fix and flip investors. And lastly, SFR and fix and flip investors are finding success in different markets. So as far as the strong market activity, pressure is certainly driving down profits in markets like Phoenix. You'll see in the right there, leading with the fix and flip activity is Phoenix. On the lowest gross profit percentage, second to the bottom as far as profit margin. So Phoenix has highest activity, yet second lowest gross profit percentage. If we look at the top left graph, we look at strong performing gross profit. You see a direct correlation there with the age of the homes in that MSA, right? Percentage of properties built before 1980, you see the higher marks there. And third and final, which I thought was most interesting in this look, SFR and fix and flip investors are finding success in different markets. Truly a direct inverse between where you see the top SFR markets, you'll see the bottom performing fix and flip as it relates to profit. And then when we look at the top 10 gross profits in fix and flip, you'll see the lower performing SFR. So very interesting look when you look at fix and flip and SFR side by side. I think you'll see here on the asterisks for the lowest gross profit markets, Boise, Ogden, Charlotte, those were also showing as the top SFR markets on our earlier slide. So a good look and a lot of good data to compare when you're looking at SFR and fix and flip strategies.
Sure. Thank you very much, Ben. Peter, if you can go to the next slide real quick. These are the build to rent markets across the country. It's pretty interesting because you see a lot of activity that we mentioned at the top of the discussion, tier 1, tier 2, tier 3, tier 4 markets for that matter. Build for rent is super popular, tracking currently about 240 to 300 purpose-built built for rent subdivisions. So that's a big shift that's occurring in the built for rent market during 2020. Let's go to, we've just got a couple of minutes left. Let's go to audience questions. Mr. Roxborough, this is a great question. We should have had it on our original question list, so we appreciate you bringing that up. What has been the impact on low interest rates, low mortgage rates for homeowners in the SFR rental space? Who would like to take that? Tim?
I mean, it has, again, going back to an earlier comment that I made, the low interest rate environment is driving home ownership, and that's a different conversation. It's mutually exclusive to the single family rental conversation. Again, this is not an alternative lifestyle to buying a home. This is a lifestyle. And so those low interest rates that are driving the refinance boom, that are driving potentially purchases, is separate and distinct from what is currently driving the single family rental investment, which is a lifestyle that many are choosing. If you just look at and listen to what the Dallas Tanner says for Invitation Homes in his last quarterly earnings call, what he specifically said is they have a pipeline of millennials that are coming into their homes that would last a decade. Rates are going to go up and they're going to go down over the next 10 years.
Sure.
That doesn't preclude the millennials making this choice to choose SFRs.
Sure. Sean, could you address this question from Paul in our audience? It's a good one. In that pre-COVID, a big factor as we made decisions on rental home investment was what is the unemployment rate in that MSA or that particular submarket? What's the new now with unemployment at 10 or 11%, expected to continue, large-scale unemployment figures, unfortunately, probably through 2020. What's the new unit of measure that you use from a single-family rental investment standpoint?
How many trillions of dollars the government pumps into the economy? No, but I mean, it's hard to answer that. I mean, if they keep putting in trillions of dollars, then the unemployment rate matters less. And I think that that's the key. But you can't control what you can't control. And I know, if people are not working and they can't pay their bills, we're all going to have problems. But I think the more important thing is to look at where people are going. And when you look at the NASDAQ that's up 30% plus this year, you got to start to understand why. It's because DocuSign's off the charts, Zoom that we're all on is off the charts, and people can work remotely. And where are they going? Where are they moving to? Technology is kind of at the core of what COVID has accelerated. Obviously, we all use tech, but COVID has accelerated all of the tech trends. And so now, it's enabled people to kind of work in all these remote locations. I was in a building the other day, in an office building. There was a line to get into the elevator, and it was only a 10-story building. You could imagine in downtown Manhattan, 100 stories. How are you going to get to the 100th floor? And when are you going to get to the 100th floor? And the same thing goes for multifamily. I mean, if I don't want to live on the 100th floor and wait in line to get to my top beautiful view multifamily unit. So I do think that you have to focus on what you can control. And it's really hard to figure out what is the catalyst to keep us propped up, because there's a dislocation between what's happening on the streets and what's happening in the market in some respects. But big companies do well with balance sheets when other companies go under. And you're starting to see these small businesses go under, and the stock market's not small businesses. So I do feel like COVID has accelerated a lot of the trends, a lot of the domestic trends, a lot of the drive-to markets. And it'll only continue to do it because it's a horizontally complex business. Single family rentals is super complex, but the only reason you can actually manage them at scale to any type of efficiency, and Matt mentioned this earlier, but you have IoT in homes that all speaks to software now. You can start to run these things horizontally in a very efficient way, and if demand's going out in those areas and you can control costs and expenses, it becomes the best place to put your money, in my opinion.
Sure. Yeah, agreed 100%. Brittany, you've got a great question. The question specific to Detroit, but I think it relates to most major MSAs. And that's, what do you think about urban core markets such as Detroit or other urban cores? And how are they going to be affected by COVID-19? Gentlemen, who would like to take that?
I'll volley that one and get it started anyways. I think, urban core markets are still desirable for a lot of reasons. And, although there's some portion of the population who's adjusting and saying, hey, let's go to a tier 2 city, or let's move to Phoenix or Atlanta where I can work from home and have a big yard. I think there's still a tremendous amount of people that want to live in Manhattan or San Francisco or these or even a downtown Detroit, because that's just a lifestyle that fits their desires and needs.
Agreed. Tim or Ben, and we'll wrap up here in about 1 minute.
Yeah, I mean, I think the pressure is going to be on the urban core. The pressure is going to be on commercial real estate. I agree with Matt that there is going to still be a need, a want for multifamily. Tricon has a multifamily portfolio as well that is doing just fine, just like their SFR portfolio is. So I don't think there's going to be, even though there's a de-urbanization, it's not going to decimate cities. That's not to say that there won't be downward pressure on commercial real estate on a go-forward basis in these cities.
It's almost as if, within cities, there's going to be pockets that excel and product types that excel. To your point, commercial real estate being at risk. But you could imagine even in places like San Diego, downtown San Diego, is taking a bit of a bath, whereas La Jolla, everybody's moving to La Jolla because you have single family residences. You could see the same type of thing where you see these SFRs in, outside of the full vertical product excel, while multifamily takes a bit of a hit. And we're starting to see that in the numbers as well.
Sure. Well, thank you very much, panelists, for joining in today and working with me and IMN over the course of the last couple of weeks.
Thanks, Jeff.
To prepare for today's questions. Attendees, please click on your agenda button to really review what's coming up, forthcoming in regards to panelists. IMN, again, has just done a terrific job, really included the industry experts, and we've got a great couple of days ahead. So thank you very much for tuning in this morning. We'll see you later on in the IMN conference.
Yeah, thank you very much.
Thank you. Thanks,
Just
industry.
on behalf
Thanks,
of
Jeff.
IMN, I'd like to thank each of the speakers for the work they put into this, as Jeff just has done. It really was a great way to open the conference. For all the attendees, please be sure to fill out your evaluation for the session in Hub. It's just a few quick questions, and please remember that the session actually needs to be added to your personal schedule in Hub for you to be able to evaluate it. Our next session, which is an overview of financing in the single family rental market, will begin in 15 minutes. And you can access this the same way you did this through the sessions tab within Hub. And in the meantime, I'd really encourage you all to explore the platform, the exhibit hall, schedule meetings, use the chat function within the next session once that launches as well. And finally, just thank you all very much again.